you know when you've got a big idea, and I can't tell you, exactly what happens within your nervous system or brain at that time, but we've had a relatively few big ideas, good ideas over the years. I don't know how many you think we've had in aggregate, Holly, in career, maybe 25 each or something.
If you took the top 15 out of Berkshire Hathaway, most of you people wouldn't be here. So roughly one every 2 years.
Yeah, one every year or two. And sometimes there'll be a bunch of them like in 1973 and 4. But the problem is for us is that big now really means big. I mean, it has to be billions of dollars to move the needle very much at Berkshire. But I would say that when I would turn those pages 50 years ago in the Moody's manuals, I would know when I hit a big idea. I've got a half a dozen of them that I keep the Xeroxes from those reports around from 50 years ago, just because it was so obvious that they were incredible. And that happens every now and then. When I met Lorimer Davidson, in end of January 1951, and he spent 4 hours or 5 hours with me explaining Geico, I knew it was a big idea. 8 months later, or probably 10 months later, I wrote an article for the Commercial and Financial Chronicle on the security I like best. It was a big idea. When I found Western Insurance Securities, I knew it was a big idea. I couldn't put millions of dollars into it, but I didn't have millions, so it didn't make any difference. And we've seen things subsequently, and we'll see. If we have a normal lifespan, we'll see a few more before we get done. But I can't tell you that exactly how. I can't tell you exactly what transpires in my mind that says, flashes a neon sign up that says this is a big idea. What happens with you, Charlie? Actually, I have a real system. My idea of a truly big idea is one I get and I call Charlie and he only says no, rather than that's the worst idea I've ever heard of. But if he just says no, it's a hell of an idea.
The game in our kind of life is being able to recognize a good idea when you rarely get it, and where it rarely is presented to you. And I think that's something you have to prepare for over a long period. What is the old saying? That opportunity comes to the prepared mind. And I don't think you can teach people in 2 minutes how to have a prepared mind. But that's the game.
Things we learned 40 years ago, though, will help and recognize the next big idea.
And on opportunity cost, going back to that, the current freshman economics text, which is sweeping the country, has right in practically the first page, and it says all intelligent people should think primarily in terms of opportunity cost. And that's obviously correct. But it's very hard to teach business based on opportunity cost. It's much easier to teach the capital assets pricing model, where you can just punch in numbers and out come numbers. And therefore, people teach what is easy to teach instead of what is correct to teach. It reminds me of Einstein's famous saying. He says, everything should be made as simple as possible, but no more simple.
Write that down. Area 2.
Good afternoon. My name is Pavel Began. I'm from Minsk, Belarus, and I have 2 questions. And before I'll have questions for you, I'd like to say thank you for recommending to read Intelligent Investor. It's a terrific book, and it reshaped me tremendously, literally overnight. So I'd like to thank you for that. And now the question. Say I'm an owner of the business, and the business has a durable competitive advantage and superior business model and is run by able people. And then, I start noticing that basically management starts doing things which are far from intelligent. So what should I do as an owner, as an investor? Should I try to tell them how they should run the business, or should I just sit back and do nothing? Because superior business model should overcome poor management. That's the first question. And the second question is how important is nominal experience in the business of investing? And by saying nominal, I mean the number of the actual time you've been in the business, as opposed to real experience that also includes experience you acquire from, say, Ben Graham or you or Peter Lynch when you read books. So those are the questions.
On your first question, did you assume that you had control of the business, or you just owned a marketable security?
Yes, if I own, say, 20% of marketable securities.
Well, the situation you described is not hypothetical in the first case. And I would say that the history that Charlie and I have had of persuading decent, intelligent people who we thought were doing unintelligent things to change their course of action has been poor. Would you agree with that, Charlie?
Worse than poor.
Yeah. So I would say that if you really think you're in with people that have got a good business but that are going to keep doing dumb things with your money, you'll probably do better to get out and get in with people who've got a good business and you think they're going to do sensible things with it. I mean, you've got that option. Now, you also have the option of trying to persuade them to change their mind, but it's just very, very difficult. I mean, it is, that's been something we've faced for 50 years. And initially, we faced it from a position where nobody even knew who the hell we were or anything of the sort. But we've acquired a certain stature over time, perhaps, in talking on the subject. And we've written on the subject. And we still don't get very far. I mean, when people want to do something, they want to do something. And they didn't rise to become the CEO of a company to have some shareholder tell them that their most recent idea is dumb. I mean, that is just not the type that gets to the top. So I would say that as a matter of investment technique, and maybe as a matter of avoiding stress in your life and all that sort of thing, and dealing with smaller quantities of stock so it's easier to sell and buy and all that sort of thing, I would say that it's better to be in with a management you're simpatico with than simply to be in a great business with a management that's bent on doing things that don't make much sense to you. Charlie?
Well, I certainly agree with that.
Second question, I gather, is sort of how much does our actual business experience versus book experience help us, or is it?
Well, I'd say, if you look at a person who has just like 2 years of being in the business of investing and versus a person who has been for 10 years in the business of investing, and say the person who has been for 2 years has read a lot about, Ben Graham's techniques and your techniques and, say, Peter Lynch techniques. So would you say that the person who has only 2 years of experience may do much better than the second person?
Well, if everything else is equal, I mean, everything else is equal, except the amount of experience you had. I think the experience is probably useful, but it isn't going to be equal. And I think it's way more important what you've thought about for 2 years than what you practiced for 10 years. So if there's a divergence in techniques applied, I would rather be with the one that I'm philosophically in sync with. If I'm philosophically in sync with both, and one's had 10 years of experience, the chances are they will know a little bit more about more businesses if they've been around for 10 years looking at them than if they've been around for 2 years. But the biggest thing is that basically they've got their heads screwed on right in the first place in terms of how they value businesses and how they look at stocks, as whether they look at them as pieces of businesses or whether they look at them as little things that move around and that you can tell a lot by looking at charts or listening to strategists on or something of the sort. Charlie and I learned a lot about a lot of businesses over 40 or 50 years. But I would say that in terms of the new things that would come to us, at the end of the second year, we were probably about as good judges of them as we would be today. But I think there's a little plus to having seen more in terms of human behavior and that sort of thing than knowing about the specifics of a given business model. Charlie?
Yeah, I think that I've watched Warren for a long time now, and I would say he's actually getting better as he gets older. Not at golf or many other activities, but
stay with generalities.
As an investor, he's better. Which I think is remarkable. It shows that scale of experience matters.
Yeah, it helps somewhat to have seen a lot of business situations. I mean, Charlie talks about models, and you construct your models as you go along based on observation. And your models will, if you're paying attention, your models will be somewhat better the more years you spent really observing and not just trying to make everything fit into what you saw the first few years. Area 3.
Hi, my name is Richard Marble from Washington, D.C., and my question has to do with the intrinsic value of Berkshire Hathaway. You've stated several times that you would prefer the stock to be neither overvalued nor undervalued, so that the time people spend owning the security represents a gain from what the security did, the results during that period of time. However, it's a very difficult security to value because of the disparate pieces. And as we saw last year, when you provide a little bit of guidance, in last year's annual report, you said that when the stock price hit $45,000 a share, you considered buying, but thought it was unfair until the annual report came out, so everyone had the same information. And while I also realize that you don't feel there is a particular quote-unquote correct number, would you ever consider giving any guidance in this direction?
Yeah, the answer is we really wouldn't. I mean, to the extent that we were going to repurchase shares, you could certainly interpret that as indicating that we thought it was attractive from the standpoint of remaining shareholders to do so, and we certainly wouldn't be paying over intrinsic value, at least in our judgment, and benefiting the exiting shareholders to the disadvantage of the continuing shareholders. So you might draw that conclusion at that point, but other than that, we would prefer Berkshire shares to fluctuate far less than they do, because we would like ideally we would like the experience of every investor during the time they held the shares to be exactly proportionate to the progress or lack thereof of the business. And I think we've come over the years reasonably close to that compared to most companies, but the nature of markets is such that reasonably close is probably as good as it's going to get. We don't know the exact intrinsic value of Berkshire, obviously, and if you looked at the figures, if we'd written down secret figures ever since 1965, some of them would look silly now in terms of what has actually transpired. But we try to give you. I think Berkshire is easier to value than most businesses, actually, because we give you all the information that at least is important to us in valuing it. And then the biggest judgment you have to make is how well capital will be deployed in the future. Because it's relatively easy to figure out the present value of most of our businesses. But the question becomes, what do we do with the money as it comes in? And that will have a huge impact on the value 10 years from now. And that will depend a lot on the environment in which we operate over the next 10 years. There'll be a lot of luck in it. I think there's a reasonable chance of good luck, but who knows? It would be a mistake for us to do anything, a big mistake, to ever recommend buying or selling the stock. How would you tell everybody to do it at once? You would negate your own advice you're certainly not going to tell one person, to the advantage or the disadvantage of somebody else. So there's really no way for us to ever talk about whether we think the stock, whether we think it's a buy or a sale, except to the extent, like I say, on repurchases, where there's obviously an implicit judgment being given the shareholders. Charlie?
Yeah. I rather like the way it's worked out. If you average out the period that we've been through, we've come within hailing distance of the objective of having our stock track its intrinsic value. It gets a little ahead sometimes and a little behind other times, but averaged out, it's worked pretty well.